Welcome back to the Hurdle Rate, episode 36 for the week of November 17th, 2025. I'm Tim Kotzman. I'm here with Jeff Walton, Ben Workman, and Matt Cole. And we have a few things we might get into this week, including sentiment versus conviction. The latest strategy buy. I know Jeff always likes those. Maybe the December SETA dividend. Lots of conferences last week. I think Ben and Matt were in Miami at the Cantor conference. Jeff was over in Prague and Amsterdam. I saw Jeff in Amsterdam, so a lot to cover there. And this Thursday is the latest Bitcoin Treasury's digital conference for November. Macro, AI, rate cuts. Like, are we simply experiencing a rate cut tantrum? Maybe, maybe not. Maybe we could discuss it. Maybe too early to talk about a Santa Claus rally, but yeah, Amsterdam conference was interesting. Incredible production value if you saw any of the pictures. I heard a rumor that the camera switching every 6 seconds may have been inspired by the New York City Unconference, but I'm sure that's just a rumor. I did not have on my bingo card Tyler and Cameron talking about Zcash and their Zcash Treasury company from stage. I don't have an opinion on Zcash. I haven't studied it, but I did not have that on my bingo card. So that's all I have. Over to you, Jeff, or whoever.
Yeah. Bitcoin Amsterdam was super interesting. It was like rave meets Bitcoin. It was this dark room. It was called the Sugar Factory. It used to be an old sugar factory. No windows in the entire place. So they had lasers everywhere, big video screens and stages, and then separate rooms with different stages and booths and things. But yeah, I think it was an interesting conference, and it made me start to think, at least over the last couple of days, like, what's the point of these things? What's the point of Bitcoin conferences? What is the outcome that is desired out of having a Bitcoin conference? It's like, well, in my mind, it's a confluence of people to talk about, the state of the market, what's happening moving forward, like where the market is evolving. And that inherently, with the evolution of Bitcoin, as it becomes a larger and larger network, is going to piss a cohort of people off every single year, because there's going to be a larger network, more people, a larger network, more people, and that the control of that narrative and how it's shifting is going to shift to whatever the biggest energy suck is in the market at that time. So a majority of the second day was about Bitcoin Treasury companies. Almost every single panel on the main stage was around some sort of Bitcoin Treasury company, basically a corporation that's putting Bitcoin on their balance sheet and doing different things with it. But it was interesting to see also the European perspective, which it does seem like the European perspective is significantly further behind the US. I mean, the European side of the Bitcoin world doesn't necessarily have a strategy, like a big leader in the market that's driving forward a significant pile of Bitcoin in their corporate balance sheet to push corporate narratives in this jurisdiction. So that was pretty apparent. It seems like it's very similar to the US. A lot of people are working in the Bitcoin space and spinning their wheels in a very inefficient, like small impact locations, where a lot of energy could be diverted into like a little bit more high impact locations, particularly around like the lending side. This is just my opinion, where I think Bitcoin lending is important. Like lending to people that hold Bitcoin, I think, is an incredibly important. I think we need it within the market. However, taking the other side of that transaction is a high risk, is like a higher risk transaction, and nobody really wants to take the dollar side of that bet. It's really difficult to convince somebody to take the dollar side of that bet on the other side of that trade. So lending to a Bitcoiner, like lending cash to a Bitcoiner, collateralized by Bitcoin. Whereas the other side, a corporation that's providing Bitcoin-backed, preferred equity products that are paying fixed income, is a completely different pool of capital that you're attracting into the Bitcoin ecosystem. So it's lower risk, high yield, as opposed to high risk, low yield over on the lending side. So that's just how I'm seeing things. I know there was a lot of frustration. Some people said it was the worst Bitcoin conference they've ever been to. But I think there's a divergence ultimately happening where there are people in suits that are, holding Bitcoin on behalf of their corporation, and that they're operating with that Bitcoin in a new way. And I think there will be this kind of split into a more like commercial, uh, financialized Bitcoin professional ecosystem, and then the cultural, artistic uh, Bitcoin ethos. So I think we are starting to see this kind of natural split.
Do you think that there's some fatigue or out there around the events? I've always
Yeah.
wondered, as these have grown kind of in scale, and you're getting, a lot of the same people coming to speak at these, and particularly during periods like right now where Bitcoin's been dragging for months now, well, you could argue a year. Now it's just kind of been grinding sideways, and there hasn't been a ton of change out there. I think you do hit a point where there might be some fatigue, but those conferences get real exciting as soon as things are moving again. And my thesis around those has kind of always been that eventually they'll sort of split. To your point, there's becoming this really high area of focus in the corporations that are bringing Bitcoin onto the balance sheet, that are issuing new products into the market. And I think that's kind of becoming its own standalone topic. And so eventually, I'm guessing that you'll go back to seeing Bitcoin, kind of the cultural, the self-custody aspects of it, all of that, the layer twos, everything that's being built on top of it, showing up in one event, and then you'll have the corporations coming off into their own. It just seems like a natural progression as the corporate side grows in scale here, and it's been doing that fast.
If I were to have brought a insurance company CEO to Bitcoin Amsterdam, he would have puked, right? This is horrible. Get me out of here. This is like I don't get this, this feels like gross. And like that's where the divergence probably is. Like there needs to be similar to Tim, what you put together with the Bitcoin Unconference. Like it was very professional. It was held in New York. It was very light, open. It was talking about like the financialization and securitization of Bitcoin. It was very focused. These are the topics, and it was small, and there was a lot of alpha there of like what's actually happening within the Bitcoin ecosystem. So I think we'll continue to see this divergence of like cultural and professional.
Are you saying, Jeff, if someone from the insurance industry, because it was more of a Bitcoin focused, Bitcoin maximalist sort of conference, or something else that I'm missing?
Yeah, they just would have been, I guess, spooked by like, wait, you're telling me to invest in like this ecosystem or ethos, and it's just
less corporate.
It's way less corporate. Really hard to onto grasp onto it,
Okay, that makes sense to me. Just a quick note. I at first heard some feedback that Amsterdam was more like Bitcoin maximalist, and I thought to myself, well, maybe I won't go because I don't want to like stand up on stage and like talk about Bitcoin treasuries and have people like throwing tomatoes at me. So it was good to see what the reality was of kind of having both in the same conference. And obviously the symposium really just focused on treasuries the day before on the Wednesday before the Thursday, Friday. But I actually was up in the Whale area talking to some of the treasury company CEOs, and I said, you should have your own conference in your country for like, if you're going to have all these dollars, then you can control the programming, even if it's just a couple dozen people there, live stream it out. And they're like, that's genius. So to Ben's point, I think you could see, I'm not trying to give away all my secrets, but I think that's a natural progression. And I think there is something to, right. If you have dollars as a corporation and you want to direct and kind of control some of that, I think that without there being a bajillion conferences, but again, if there's just kind of like local, couple dozen people, one day a conference, one day a skiing, it sounds pretty good to me.
Yeah, I think one of the things that's become pretty clear to me at these conferences, being in a different way, the Bitcoin Amsterdam experience that y'all had, and then Ben and I were in Miami at the Cantor conference last week, and I was on a panel with a bunch of Bitcoin Treasury CEOs and leaders from Adam Back to Jack Mallers to Dylan LeClaire. And I think what you're seeing is massively different viewpoints towards the future. Different viewpoints amongst Bitcoin Treasury company leaders and visions. And like as an example, our vision and strategies around building the digital credit ecosystem and building prefs and obviously like today, days like today when you have massive red markets, it's nice because there's no margin, no encumbered Bitcoin, nothing to worry about. And then other leaders like Jack Mallers saying, we're not really a Bitcoin treasury company. We're building a business. And is that right or wrong? It's just different, right? But very fundamentally different viewpoints where maybe in May when everything was ripping, it was like, here's Bitcoin treasury company A, here's Bitcoin treasury company B, here's Bitcoin treasury company 3. They're just all Bitcoin treasury companies. Massively different. And then you go to Amsterdam and I think the Bitcoin treasury company that bought the conference is into Zcash. And like massively different, right? And so you're seeing these differences emerge as strategies are being implemented, and you have the hardcore libertarian Bitcoiners that maybe don't like the Bitcoin treasury companies, and I think that one of the nice things about these down markets is it actually funnels up these differences and these debates where in the good times it might just seem like everyone's just talking the exact same book. We're actually not talking the same book. Now we all fundamentally believe in Bitcoin as a great base asset, or at least most of us do. But what actually comes about that? There's a lot of differences and there's a lot of room for debate, and I think that debate is healthy for the ecosystem. That when I go to conferences, it's much more fun to go up there and debate with someone than to all be saying the exact same thing for an hour. And I think that those debates can then funnel an understanding amongst the community of where different people stand on different issues, and people can then the sub conferences or the separate conferences to your point, Tim, is where you can actually go very deep in a narrow subject where you bring all these different people together with massively different viewpoints. And I think it's actually nice to hear the differences kind of bubble up to the top. And I think that's what we're seeing across these conferences right now. So from my perspective, it's never been more fun to go to them because of that, because people I think are in different positions and feeling a little bit of desire to tell their differences of opinion.
That was, to me, the most interesting part about being at that conference was the panel that you were on. You had Adam Back, you had Jack Mallers, you had Dylan LeClaire, and then I'm blanking on the lady's name from Reserve One. But you had all these well-known companies up there, and I would have expected the strategies to be more similar than different. And when everyone talked through them, it was clear that everybody's approaching this differently. And I think part of that is a learning from what you're seeing in the markets right now. I think that there's this big push and this reaction right now to differentiate in some way. And so you're seeing this migration from companies that haven't yet really gotten out of the starting blocks, right? So a lot of these are going through a de-SPAC process, and that process just takes a long time. So it's been dragging on for a while. And so there's a lot of time in that process where you can evaluate what's happening in the market. And what you're starting to see come out of that is some, like Jack, saying, we're not a treasury company, we're building a Bitcoin financial services business. That's what we're doing here. He even said he'd never heard the term DAT. And I don't know if I believe that or not, but it made for a good quote while he was up there. Said he hasn't asked Dylan before that. But then Adam Back and the Bitcoin Standard one, they had a bunch of different financing structures that they were putting in place. So they're very clearly not moving to a pref-only type of a model. We're obviously a pref-only type of a model. Metaplanet's a little bit of a hybrid. They've got the operating business that they're focusing on. They've got the income generation business that they're focusing on. And clearly they're pushing towards getting a pref out in Japan. But, it's a slightly different version of the model. And I think you're going to see that pretty broadly now. I think that these markets, when you see it like this, we got Bitcoin down at around 92,000 at the time that we're recording this. We had a very bloody Monday in the markets.
It's up a little bit.
Yeah. And I think people are squirming a bit. And, as leaders in these companies, it's never as fun to have these down days, clearly. But I think that for some of the smaller ones, this is going to cause some reevaluation of the way they're going to operate. I look at this and I think we're on the right path. The volatility has returned to Bitcoin now. It didn't come the direction everybody wanted it to come initially, but the volatility is back in the market. We're clearly seeing that. You're seeing a lot of liquidations happening. You started seeing some cracks in the lending platforms. So you're starting to, and not in the platforms themselves, but in terms of people starting to get the notices that they're starting to hit their margin requirements or liquidation levels. And so that starts to create a lot of fear out there in the market. And, I just look towards the future here and ask myself, what do I see coming? Right? Do I really believe that the broader macro conditions are slanted against Bitcoin over the next 6 to 12 months? And I just don't see that. I see liquidity coming to enter the system. I see rate cuts showing up. I just see an environment which is more what you would typically expect in a bull market. You don't typically get the bull markets when you're in restrictive monetary conditions. That's just not typically what you see. And that's really what we've seen. We've started to see the early stages of the easing showing up, but it came later than what a typical cycle would have seen in the past. And so, when I look forward and I see all those things on the horizon, to me, I see this price action and it doesn't really concern me all that much because I just see everything coming on the horizon. And the last time we saw those types of environments, Bitcoin absolutely flew. So we'll see what happens here. But to me, this is not one of those it's over moments. This is one of those, well, it's going to be here for now, but I'm expecting a lot to change in the macro environment out there. And so I'm not thinking this is that we topped and that was it. I'm not thinking that yet.
Yeah, it's like, okay, if it's over, it's like, okay, then what? Like, do the structural bids stop?
Well, I think a lot of
No.
people are asking themselves that question right now, right? If it's over, then what?
Yeah,
I
then
think
what?
this is that moment where, as investors out there, what you're asking yourself is you have this firm belief in Bitcoin while it's ripping. And when you see these types of drawdowns, and let's be clear, this is a very normal drawdown in a bull market. We haven't even
Yep.
gotten to 30% drawdown yet, right? We're what, 27, 28, something
Yeah.
like that.
33% I think would be around 82,000 is kind of what
I think it
I've
was a little higher than that when I
yeah.
looked. I think it was 86, 87. But either way, right? Like
Yeah.
we haven't had the full 30% correction. So this would still be a very normal drawdown during this market. But when you look out there and you look at the companies that are running the Bitcoin Treasury playbook, one, you get a chance to reevaluate which strategies do I believe in for the long term? What do I think is the best structure? And two, do I still believe in the thesis for Bitcoin? And I think that's something that
Big one.
investors have to ask themselves because if you believe in the thesis of Bitcoin and you do believe that the debasement in the dollar is never going to stop, Bitcoin's perfectly engineered to combat that as a store of value, Bitcoin structurally designed to move up. We're seeing a lot of demand coming on from all the places we'd always hoped it would come from. We had a central bank, the Czech central bank, bought some directly. It was the first time, to my knowledge, that a central bank actually purchased. All the big things, all the regulations we were hoping for, they're all happening. And so if you don't believe the thesis around Bitcoin is broken, then I don't believe that the thesis around the Treasury strategy is broken. But I do think that investors are going to start reevaluating where they see value in the market. How would you want to be positioned? If my working assumption was Bitcoin goes from 90,000 to 175,000 over the next 12 months, what companies do I want to be positioned in? Which structure do I think provides me the best amplified exposure to Bitcoin? And that's the question that you have to ask yourself right now if you're going to be an investor in the space. And if the thesis holds, then this is a rebalance and wait type of a period.
Shall we shift to talk about the prefs? Because there's been a lot of conversation about the prefs. There's been a little bit of volatility in the prefs. I know Matt, you and I were talking about this a little bit before the show started, which I think it would be good to provide some perspective of, trying to compare these to some of the other things in the market. And then additionally, just to lay the land, I was my wife went to the Bitcoin conference here in Amsterdam as well, and one of her takeaways was like, this all seems really complicated. And I was excited to talk to her at dinner about, oh, that's actually the really fascinating thing about, strategy and what we're doing at Strive is we are actually like taking all of the complicated things out of it, right? We're buying the Bitcoin. We are managing the custody. We are taking on the volatility on the forehead, right? So you don't have to. And that is a really appealing product if you want exposure to the space. And it's an interesting way to get exposure to the space without having to do custody, cold storage, manage keys, insurance, and manage the volatility. Like that's a really appealing value proposition. And she was like, "Wow, that sounds great." Like, wow, I've actually been working on this for like a long time. Anyway, so I'll pass it over to you, Matt. It maybe be helpful to get perspective of like if you were to compare, OTC bonds that are trading very infrequently with large spreads, like if those were traded publicly by retail with options chains, they would likely be very volatile.
Yeah, yeah,
Yeah.
yeah, this gets into what do most Americans already own that they're not probably watching on a daily basis. And so the average American retirement account's in something like a 60-40 fund, right? And so 60% equities, 40% fixed income. Well, what is that fixed income that makes up 40% of the retirement accounts of most Americans? And the most common construction is what's known as the Bloomberg Ag. It's an index that owns basically the entire market of bonds. So think about it as like the S&P 500, but for bonds, and in bonds it's not 500, it's like 5 million. But basically a broad market index of all the different bonds, corporate bonds, mortgage-backed securities, U.S. Treasuries, all put together into one index. Okay, so what does this index look like? Because when you actually understand it, you start to realize how great the prefs are, even with the volatility that they saw today. Because what you'll know is that the Bloomberg Ag has a duration of about 6 years and a yield of about 6%. Okay, so what does a duration of 6 years mean, and how do bond portfolio managers model that risk? What bond portfolio managers do is they look at changes of interest rates, typically up and down 3% or 300 basis points. And so what duration of 6 means is that for a 100 basis point move up or down, you would expect the price of the bond index to move 6%. And so if you're modeling 300% in each direction or 300 basis points, you take 6 times 3. So 18% up or 18% down. That's kind of the standard risk that you're modeling in a bond portfolio. And that's a 36% difference from the bottom to the top of that range. And so then you look at a bond, like a pref like STRC, that where did it close today? It had, a horrible day for it today. It closed at 94.58. So it's, 5.5 points off the stated amount. Okay, 5.5 points. That is, you know, if you think about a normal bond portfolio, 18 points down, 18 points up, that would be like STRC trading in a effectively 82 to 118 range. And so imagine that's a 60-40 portfolio. Is an 82 to 118 range for most for non-crisis moves. So a crisis move would be even outside of that range, but a non-crisis, large move in basically a 40-point spread. And with STRC, we've brought down the volatility, and obviously SETA as well. But I guess it'll remain to be seen if it can actually peg at 100. But even if it doesn't, the lack of volatility that it's showing right now, and with a substantially higher yield, and with tax deferred nature to it, it's just a great product. And I think that the notion that oh well, it's down 5 points, it's over. I couldn't disagree more, because of what I know it should be compared against, and what most people own. It's just so substantially better that we're still learning to understand these products. I mean, it was 2 months ago that we didn't even know about the rock dividend nature to them, right? These products are novel, they're evolving, but I think what we understand pretty well is when you can underwrite Bitcoin risk and you can strip down the volatility on one side, and then put that volatility into the other instrument, that you can take the Bitcoin and create, you basically have three great options. Do you want income? Do you like money? Do you like just Bitcoin itself, or do you like amplified Bitcoin? And I think all of those will have a unique buyer that's going to have different risk profiles and different needs in it, and it will look very attractive, likely in my view, over the long run relative to traditional asset classes.
So with a typical bond that's OTC, that's got a 6-year duration, let's say 6% interest rate, as a bond portfolio manager, like are you thinking, well, okay, I need to hold this for 6 years to manage and mitigate that volatility? Like what's the long-term perspective of the hold period with
Yeah,
that amount?
so funny enough, it's actually similar to how Saylor would describe investing in Bitcoin or Bitcoin treasury companies. So almost every single manager of a bond fund, they're going to get judged on a short-term basis on a 1 year time horizon, but really they're really trying to outperform over 3 and 4 year periods. And so you think about a 3 or 4 year period, and then you compare that to Bitcoin, never had a negative 4 year period in its history, right? That these are what's considered normal holding time frames. Don't want to say duration too many times. Normal time frames for holding a bond portfolio, that you would want to hold it for multiple years, right? If you're looking to have a money market account, then that's not what most 60/40 portfolios are in, right? That's what someone's checking account is in. But the investment accounts of Americans, of pension funds, of name your place where there's trillions and trillions and trillions of assets, are not in those short duration instruments. That's typically just for someone's checking account. And so I think you can just so easily see how this lack of volatility is extremely attractive, even with, days like today where, they're down 3-4%.
Except these are even different, right? Because as it's trading lower, if it stays at these ranges for a while, what you know is that the company is going to actively work to move it back up.
Mhm.
Right. These are incredibly unique instruments that are out there, particularly the variable rate ones. The other ones are going to float where they're going to float, but particularly stretch. You see it, DPEG move down from the stated amount, drops down to 94. What you know is if that persists, strategy is going to intervene and they're going to start taking actions. And I made a post this morning because over the weekend, we've been through these periods several times before, where it starts getting really loud, people completely lose faith in what strategy is doing and now what the broader ecosystem of treasury companies is doing. And they start immediately flipping over to solvency and liquidations and all these things. And,
It's just
you know, I,
laughable.
so I wanted to put it in terms that are easy to relate to in people's personal lives, because I think when we see the numbers associated with strategy, they sound so crazy that I think people lose perspective because they've got $787 million in interest obligations between the prefs and the convertible bonds. Now that includes stream as well in that number. But if you take the assets that they're holding, just the Bitcoin, and you broke that down and normalized it to what is this relative to $1 million? If I knew someone that had $1 million in liquid assets, right, cash equivalents, how much would that be that they're paying? Because 787 million sounds like a lot. Well, relative to $1 million, it's $12,800 a year. So if you knew someone with $1 million liquid, do you start becoming concerned about their solvency and their ability to make those payments of $12,800 a year? Like, well, probably not, right? And if you are going to start getting concerned, back to my point earlier, your concern must be around Bitcoin failing from here. It's over.
Yeah.
Bitcoin's never going to be adopted. It's never going to pick up any more adoption. Banks aren't going to come. Countries aren't going to come. Individuals no longer see value in protecting value from debasement. All those things have to go to the wayside, and then you can start talking about the solvency. But at this point, strategy is, one of the most solvent companies you can find. So I think while it makes for great headlines, and I'm sure it gets amazing engagement out there, it's just not reality. They have all the assets to back this up, and they have a lot of other tools that haven't even been deployed yet to back these up as needed. So
you think about what must be true for the fall of the prefs or even the fall of the common equity, and it has to be the fall of Bitcoin. And so then every argument that the pro Bitcoin side that will argue against strategy, the common or the prefs make also falls. What is the value of a Bitcoin operating business in the case that Bitcoin fails? Nothing or
Zero.
almost nothing. So you really just have to be comfortable to say we are going to underwrite Bitcoin risk. We are going to spend our time building something of value with or on Bitcoin. And then as a fiduciary, the next question is, how do I maximize value for our shareholders building something on or with Bitcoin? And that is the genius of the prefs is your Bitcoin's not encumbered. There's no margin risk. You've taken out maturity risk. You can ride out the duration. So you're able to ride out this long duration asset. And if the bull thesis is right, you're, to use what other people say, you're not working for what another man can print. You're actually even going further in the direction of the bull case of Bitcoin. And it just works if the Bitcoin bull thesis works. And if the Bitcoin bull thesis doesn't work, then clearly amplified Bitcoin doesn't work. But you're able to ride out the duration of that, right? That is to use the insurance. That is the risk that you're underwriting. Like we're always underwriting risk in every single decision we make in life. When we get in a car, you put your seatbelt on, what car you pick, how fast you go. All these different decisions we make every single day is underwriting risk, right? And if you're a Bitcoin bull, you're trying to think about how do I maximize returns in Bitcoin, underwriting the risk that I feel comfortable underwriting. And I think what's clear to me is that there's still a lot of education to do with regards to the prefs, because I think people have in the crypto, they've seen the perps, not the prefs, but the perps, the perpetual leverage with, collateralized Bitcoin or collateralized crypto and the multi-billion-dollar liquidations. And so anytime Bitcoin falls down, it's strategy selling. What is happening? And you just say, you're either being dishonest or you don't get it. And I think you probably don't get it. I'm gonna use that, and we're gonna educate you on why these are the perfect instruments to amplify Bitcoin exposure. And I just think that there's a lot of great debates to be had that I think will help educate people that currently don't understand.
So, as you guys said, these prefs are so novel and unique and new. When someone hears the language pegged to 100, what comes to my mind is like a stable coin. And especially with how volatile markets can be, can somebody explain like why it would be above or below 100 and that it's not broken if it's not pegged to 100? Does that make any sense?
What I would say is if you look at the strategic decision making embedded in the prefs, they don't make decisions on a daily basis. They don't make decisions on an intraday basis, or they don't, fundamentally necessarily even make decisions on changes on a weekly basis, right? It's almost like that you're within a month time frame, you're watching fluctuations, and then you're choosing strategic decision points. Do you raise the interest rate? Do you lower the interest rate? You are actively working to keep it at 100, but you're not looking to do it on an intraday basis. And I think that disconnect is not a problem, but it does present the potential for intraday movements of letting the market play out. But I don't think that is broken. What would you say, Ben?
Yeah, I would say when you're looking at all the levers that companies are pulling to manage these, and we'll just use Stretch as the example because that's the one that's been operating in the market for the longest, where a lot of these adjustments have taken place. What they're looking to do is find equilibrium in the market. So, for instance, you've seen them in the past raising the dividend rate on Stretch to kind of push that price up. And what they're looking for is at what rate is this such an attractive product that we have consistent demand around $100. either where people are holding onto it and not selling it, so any new buyers coming into the market are pushing that price up. But what they want is for that demand to kind of be butting up against 100 all the time. And if it goes above, strategy is the one to manage it back down to 100. So, if you go and market buy at 99.99 and there's not a lot out there in the market and it jumps up to 115, Sailor's probably the one selling it to you up there. Right. And so he's going to try to manage a tight band around 100 and keep pushing the price back to 100. Now, if they see excess demand, if he's absorbing a huge amount of demand up there above 100, more than, what their target would be, well, then you'd look at things like lowering the rate a little bit. So maybe they have to come down a quarter point, and that'll bring that equilibrium back, where maybe it's not every day, all day. He's just up there absorbing that excess demand above 100. It might float more naturally around 100. And I would say it's going to, they're trying to get it to float, call it within a 50-cent band up or down, right? If they're trying to manage this like a money market. So they're looking for that equilibrium point. Over time, as this matures and as the demand becomes more steady for these products, as those marketing efforts start to pay off, that's really when you'll start seeing far more of the active management. Right now, you've seen it during bursts. There's huge amounts of demand that come in. We saw it staying above 100 pretty consistently for a while last week. And then you saw this week what the output of that was, right? They were the sellers. They raised 100 and I can't remember the exact amount.
113 million.
$113 million, last week on stretch alone. So they were above there absorbing that excess demand above 100, pushing it back down to 100. And so that's kind of what you're seeing from a day-to-day management perspective. They're monitoring the daily trading level of it. And if it's trading above, they've got an action to take, right? The ATM. And they're getting more shares out there, which is going to make it more liquid, which over time will make this a far more stable product, because individuals selling off even in chunks won't have the same impact as they will before that liquidity is out there in the market. And then if it drops down below and they don't have any excess demand that they're trying to absorb, well, then they'll look at things like upping the rates and bringing that demand back into the product and making it really attractive. So that's really what you're looking at when you see a product like this. And what you're trying to do when you're doing the marketing around this is you're trying to make it feel comfortable to investors, because it's something new that they haven't seen. So they need an anchor point for that product. What is the intent of this product? What is it trying to be? And the broadest example of that is like a money market account. And that's why you keep hearing him say that over and over, that these are meant to be, more like money market accounts, where if you're managing a treasury and you have capital that you don't need today, but maybe you need it in a month or 2 months or 3 months, right? Like, this is the product for you. You can look at this effectively like a money market account. And if the price goes down, you know that I'm going to be out there taking corrective actions to push it back up. And if it gets above, I'm going to be the one holding it down and not letting it fly away above 100. That's how you can really think about the management around these products.
I think one thing that we've talked a lot about liquidity premium on this podcast. And I think the liquidity of these instruments is likely going to increase dramatically as the balance sheet gets larger and larger and larger. You think about, why are some of the largest equities on the planet the most, like the highest volume, and the liquidity premium is you can store money there, you can pull it out easily, it's not going to impact the market, and there's a premium value for that. And now you're going to see, in my opinion, there's going to be arb traders on the bottom end of this that are going to push, anytime it goes below 100, they're going to be buying it to push it back, knowing that it's going to be going back up to 100 to arb the spread. So that's going to add more liquidity, more AI algorithm liquidity into that marketplace, which will allow other people to go in and out more quickly, because there will be arb traders kind of sitting on both sides on top of the corporate management and trying to peg it to 100. So I would suspect as the strategy balance sheet grows, doubles, triples, quadruples, we will see the liquidity of this instrument continue to grow over time. And you'll see a lot less volatility, which I think what Sailor's mentioned is like that target volatility on this instrument is probably going to be around 1 or less as the product matures. So really, like we're what, 3 months into this thing, 4 months into this thing?
Yeah, and what you need to realize is this is still a market, and there's still going to be traders in here. And I think right now they're going to end up loving an instrument like Stretch. And the reason is because you get days like today, and they look at this and they see a 5% return available to them, likely on a fairly short-term hold relative to everything else if they know the company is going to step in and intervene if it stays low for too long. So they can look at the thresholds that strategies put out there for when they're going to do 50 basis points or when they're going to do a 25 basis points. And if they see it down to those levels and they know that they're likely to intervene, they'll start stepping in and becoming the buyers. And over time, the market will get more and more efficient. Right now, like Jeff said, we're only a few months into these products even being in existence. So there's still probably a massive trading cohort out there that doesn't even know these things exist, who would love to pick up 5%, a couple times a quarter if they could. Right. I mean, if it takes a lot of the risk away, you've got the balance sheet on the other side. This would seem like a really good product where you can arb these inefficiencies during these time periods. And I think over time, that's going to cause that band to tighten. You're going to see that volatility slow down because to the downside, you're going to see other market participants step in because there's money to be made for them. And above, strategy is going to be stepping in because that's where they're going to be raising their capital. So over time, that band will compress.
As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private.
I want to go back one topic, if that's okay, and talk about underwriting Bitcoin, because I've got this topic that won't get out of my brain. When you're underwriting Bitcoin, you're kind of underwriting a populace, right? You're underwriting the people that are attending the Bitcoin conference. You're underwriting the corporations that are putting Bitcoin on the balance sheet. You are underwriting the asset management companies that are, creating ETFs for the underlying product. And that's the beauty in my mind of this process, right? Like we are underwriting the structural bid. There's like an entire ecosystem built on this stuff, and we are underwriting the incentive structure of that entire business continuing to operate. And at Bitcoin Amsterdam, I asked several people, if I gave you a single Bitcoin today, would you be willing to give me $10,000 back in fiat, in perpetuity, no strings attached? Every single person I asked said yes. There was one person that was hesitant and said, what if the dollar gets debased and everything like resets and $10,000 ends up being worth a lot more? I'm like, well, okay, come on. If that's the case, right? Like this is a whole different conversation.
Your tail risk is the U.S. fixing the monetary system.
yeah, that was the tail risk, exactly. But it was fast. It's fascinating to propose that, like to frame it that way, because that puts the onus of figuring out how to pay $10,000 in perpetuity in fiat and holding Bitcoin. So again, you have to have this long structural Bitcoin thesis, like Bitcoin is not going to break, and you feel comfortable taking that side of the trade.
Yeah, and that's the important part of that thesis. I know that the people that are operating in this space and the companies, there's been criticism out there before because people have this notion that the people running these companies believes there's absolutely no way for it to fail. And that's just silly. We're just willing to underwrite that risk, right? It's very clear how the Treasury models could fail over time. Bitcoin slams down 90% and it stays there for 15 years. Treasury companies probably aren't doing well, right? So, but at the same point, your Bitcoin in cold storage also isn't doing well. And so it really does come down to what is your fundamental conviction around the asset. That's what you're looking at. In the companies that are taking the leverage on, it's one thing if you're a company and you just effectively become a holding vehicle of Bitcoin. All you did was do one capital raise, you go out and you buy Bitcoin. Now you're a company that, if you believe Bitcoin has a 30% CAGR, you're a company growing at 30% a year, right? That's what you're doing. If you go and put amplification on and you believe in that 30%, now you're taking all that Bitcoin that you acquired, that's growing 30% a year. You're carving off, 10, 12%, whatever that cost of capital is at that time. And then that excess 20-ish percent is your incremental return. That's the amplified return that you're returning back down to the common shareholders. And so, the model is actually fairly simple when you look at it. I think it gets complicated because the market has to digest all these different types of financings. And, there's no doubt that as an investor, you've got to find the right entry points for you into this model. And there are always, with every investment, there are good entry points and there are bad entry points, right? Or better and worse entry points, I'll say. And when companies are trading, at or below their NAV, if you think that they have an ability to continue to raise capital and to continue to build that Bitcoin exposure for each of your shares over time, you can't really find better entry points than that because now every activity moving forward builds on your position from your entry point. So, there are definitely times where you need to evaluate how do you feel about the strategy? How do you feel about the companies? What do you think is the optimal form of amplification that you can put on? And if you believe in the thesis long term and you believe that the company can execute and maintain amplification to give you that outsized exposure, then you find the times when everybody's terrified and you take your position knowing that if your thesis in Bitcoin hasn't broken and this company now with every single transaction moving forward increases your Bitcoin exposure for every share you're holding, that's when you can be comfortable just sitting on your hands and waiting for 5 years, 10 years, right? Because time is what creates that compounding effect. The compounding effect for most of these hasn't even been able to start yet. Right? Most of these companies haven't even been around for a year. So you're not to the point where all the compounding starts to kick in. And so I think that is the importance of being willing to allocate and then disappear for a while, right? You don't have to watch the markets every day if you have that thesis. You can watch Bitcoin, but you don't have to watch the whipsawing up and down all the time. If you have a thesis and you had a good entry point and you believe in what Bitcoin's going to do over the long term, the investments can get really peaceful for you because you're not putting away capital you need tomorrow or next month or next quarter, right? If this is long term for you, as it should be, because that's the thesis around Bitcoin, is that Bitcoin's going to go up over the long term. It's why you hear the projections 10 years out. What's it going to be in 2035, right? That's the discussion. It's always out in the future. That's what's going to create the powerful impact here. So I think that making sure you're willing to take that type of a view, that long term of a view, is what's going to keep this as a peaceful investment for you. Otherwise, you're going to get whipsawed, right? Volatility is real, and it's far more real when it's amplified. So you got to be ready for it.
I think we need Matt to opine whether or not you should hedge with Zcash.
So I have a very strong opinion on this, and the answer is absolutely not. And I think Bitcoin is the hedge, but that may not be an appropriate answer to everyone. And so I think if someone is underwriting Bitcoin risk and they don't feel comfortable with that answer, I think gold is actually the hedge. That if Bitcoin fails, like if you get all of the institutions now underwriting Bitcoin risk, pension funds buying Bitcoin, and it failed for that whatever tail risk scenario that none of us think is going to happen, the institutions aren't then going to go buy Zcash. Like that is not a thing. What they will do potentially is, like, let's say this is some world where AI is taking over the world. Maybe people want to have a hard coin that they could in amongst their local communities transaction. Maybe that would be gold. I'm not a gold bug at all. I don't know gold, but I think there's a better thesis that I could think about in my mind for gold than Zcash as a hedge. And I don't, the more you look into it, the more I think it's a pretty shaky thesis. But you know what? The flip side of that is that for traders, it could be a great trade if you time that trade right. But a trade is very different than an investment. And I think for us, we're not interested in trades. We're interested in structural investments, long-term investments, and that is Bitcoin and then amplifying Bitcoin. And, I think if you look at a lot of the track records of the people that are talking about Zcash and you just do a simple, X search of what were they talking about in 2021, what were they talking about in 2017, you see a pretty familiar pattern. And it just ultimately comes down to people that are just not that convicted in Bitcoin as the answer, as the hedge. And so if you take someone that's not convicted in Bitcoin, or the answer or the hedge, then every few years it makes sense that they're going to have a trade that they think is of interest. And I guess to at least give them one thing that I agree with them on, I do agree with them that in today's day and age, privacy is a concern. I think it's not hard to say privacy is not a concern. I just don't think that Zcash is the answer or the investment that's going to be the solution for that. I think Bitcoin is, the hedge for the printing of money is an amazing answer. Having your own keys secured gives you massive financial freedom. And I think that is simply the answer. And I think we're out of time.
Yeah, I think Zcash is like an $11 billion market cap. It wouldn't even qualify for the S&P 500. I think you need like a $17 billion market cap to get in the S&P 500, and Bitcoin's 1.9 trillion.
That's the criticism around a lot of the coins, right? Is when you start to see what becomes pretty blatant. I'm not going to say it's coordinated, but you got everyone jumping on and amplifying one coin that's been obscure for years, right? Like it just hasn't been a focal point for a long time, and all of a sudden you can't stop seeing people talk about it. It doesn't take nearly as much money to move the price of an asset with that small of a market. So when you get traders out there and you've got all these, Discord groups and Reddit groups and all these, you just have to ask yourself, is this true conviction that just showed up in the last week and a half? Or might something else be going on? I don't know the answer, but it's the question that I'd be thinking about.
I mean, prior to this recent run in September, I mean, half of the Bitcoin Treasury companies would have had a higher market cap than the entire market cap of Zcash. It was literally so small for a coin to literally be dubbed as the hedge for Bitcoin that it's a pretty laughable thesis. And my last thought on it would be if you actually pull up the Zcash Bitcoin chart and you go back to its inception in around 2017, it's still down 95% versus Bitcoin. From the same time, like back then, that many of the same people were talking about the merits of it. And so imagine, writing something down effectively 99%, then it pumps 10x and you're still down 95%. I mean, it's not done well. And I don't think that it actually has organic demand for the product. But if you're looking for a short-term trade, the one thing I will give it right now is it has a lot of volatility. But that's not the game I'm playing.
There you have it. And Ben, are you buying the Bitcoin dip? That's the last question.
I'm always buying the Bitcoin dips. I was losing faith that I was going to be able to buy it under 100,000 again. So, I enjoy these time periods. If you've got that long-term thesis, nothing makes you happier than seeing a $200,000 coin that you get to pick up for $92,000. I'm a big fan of that. So
yeah,
I've been buying all week for me.
I always enjoy seeing your posts about buying the dip. So
Yep.
Keep it up. Well, thanks everyone for listening and watching. For Matt Cole, Ben Workman, and Jeff Walton, I'm Tim Kotzman, and we'll see you next week right here on the Hurdle Rate.